Welcome back to Markets Today. It's all about banks today. We have looked at I&M, the performance. We've looked at Standard Chartered. We want to now understand Absa and Equity Bank. Absa numbers were up 3%, whereas Equity Bank numbers were down 14.1%. What were the key drivers, and what is the outlook? We are joined via video call by Mr. Edwin Chui. He is the head of research at Dye & Blair Investment Bank. Welcome to the show, Edwin. Briefly walk us through your read-through from the numbers that have come through the banks over the last 1 week.
Okay, so generally speaking, I think there are two key themes that are coming through. Number one is the impact on loan provision impairment on the income statement. And I think the reason why this is interesting is because you're only talking about 1 month in the quarter. You're talking about March 2020. The reason why very important is because the lockdown now is going to cover Q2. So the impact that you see to the negative, we can actually expect it to be worse in Q2. That's number one. Number two, I think you're going to see difference in terms of how managers respond to this crisis in terms of the cost risk numbers. So you've seen some banks like really take hit, and then some banks that just seem to be, and that I think poses questions with respect to quality of provisioning overall since IFRS 9 came into place. And that also poses questions with respect to what we can expect when we see audited numbers at the end of the year.
Okay, what about dividends? Banks are either cancelling or postponing this. What's happening there?
So there is a need to conserve cash, which I understand. And I think I'm supportive of banks that have come and decided because the environment would be like. Also been guidance by some regulators, especially South African Reserve Bank. But as you've seen, many have to continue. The question now is, do we expect changes on? Is that we're going to see that happen? We're going to see efforts to either reduce or not pay dividend in 2020, especially as the secondary effect is such to come. The impact of credit risk in terms of the impact on SMEs. I think you've seen commentary by the central bank that if this crisis continues past another month, you might see about 3/4 of SMEs having to shut down, which is really risky.
Okay, fair enough. Thank you so much for that. Let's delve into the bank. Absa up 3% for the 1 year period from last year to this year. The only bank that actually reported some positive numbers from last week's results. What is happening there, and what are your thoughts?
So I think in terms of the top line growth, line was so good. It was, from a net interest income standpoint, it's about 4.5% up. And I think what drove income was non-funded income, about 16% up. And most of the impact was from other income and other operating income and forex income, and these are not income lines that are very repeatable. So as you'd expect, affected fees and commissions. So I think moving forward, it's a question of whether they can even actually grow at 10% on the total income line year on year, which is very unlikely. The other aspect about Absa is, of course, the increment of about 75%. Leading to a cost of risk of about 2.2%. I think one would argue that Absa is one of those banks that has actually been very good with respect to their asset quality provisioning. And that is the reason most likely why their profit after tax numbers went up, because they didn't have to take as big a hit as other banks have taken.
Okay, so then are these good numbers? Are they weak numbers? Do you expect this run rate to continue in terms of growth for the remainder of the year?
So I don't expect this, and I think this is a hard focus to make. But I don't expect this run rate to continue, specifically because if you have a cost of risk of 2.2% in Q1, the negative impact from the crisis came from 1 month, and you are now moving into another quarter where the crisis is still in play, and you are unsure what the second half of the year will be. Are you going to have another outbreak the disease? Are you going to have a phase 2, or are you going to have now secondary order effects that come to bear because everywhere else is affected? The external markets are affected. Those are all things that no one can precisely put a finger on yet. But I think one can argue that it's very hard for them to repeat this performance moving forward.
And did they declare a dividend for 2019, and will they be expected to pay this in this year?
So for 2019, they actually want to continue with the payment. Book closure is tomorrow. It was about 90 cents. So they are definitely going to continue with the payment. I think the question is whether they will now have an interim dividend for 2020. And I think they probably will not have that.
And what about the bank's capital ratios? Are they strong enough to weather the storm that comes through for the remainder of the year?
So Absa specifically, we're talking? We tend to look at capital ratios from a bank, not group standpoint. And I think the bank has about 13.8 tier 1 capital ratio. I don't think that's sufficient capital ratio in a normal environment, but I think that's okay ratio in an environment where you do not expect them to significantly work to grow the loan book. So I think with that capital ratio, they can afford to wait until things are clear, until the land markets are clear. And then moving forward, if they are going to continue with the aggressive strategy that we saw at the beginning of the year when they were transitioning into Absa, I think my expectation is in the next 1 or 2 years, they would need to get more capital, either through tier 2 debt or tier 1 capital raise.
Supplementary capital or a rights issue. I think the final question on Absa, everybody likes it. It's a high dividend yielding stock on the NSE. Is it still a buy for you at these prices?
So insofar as they can retain the dividend payouts moving forward, yes, I think it's a buy. The yield is about 10% right now. It's only about 19% to date down compared to banks that are above of 30% year to date. So it's not as externalized. So it's actually very good for capital preservation, I would say. So yes, from a capital preservation standpoint, and also from a dividend yield standpoint, it's still a play for the year.
Thank you for that. Let's switch gears and look at Equity Bank. The numbers, similar period, are down 14.1% to 5.3 billion. What's happening with Equity Bank's numbers?
Wow, so Equity Bank is actually an interesting case because that the biggest factor in the negative performance is actually loan loss investment increase of about 660% to about 3.3 billion, 3.1 billion. And I think listening to their call last week, the impression we got was, number one, this is separate from restructuring that they are doing on COVID-19. So what they have done is they have taken loans that were otherwise performing, otherwise normal, but had a bit of strain here and there, maybe payment come a few days late or a few weeks late, and they have decided to put them aside and increase provision as they start to prepare for potential weakness in that book. Now that's as per the narrative, but I think what investors are worried about is that heretofore the narrative has been the bank has been providing adequately for their loans. So if you have this significant impact in cost of risk, and that impact is not related to COVID-19, then there is really a question of what else is happening in your book or has been happening in your book, either of those. And I think the only thing I can say is, number one, Equity Group has this decisiveness and agility when you look at the management decisions. That means that they are able to see something ahead and take care of it, before it comes to bear. And then I think the other thing you can highlight is with about 59% of their loans in SMEs, they are actually looking at a major risk down the road if the crisis were to continue. So I think in a way, one would say that it's actually very proactive and taking the heat down, and instead of waiting down the road for when things are likely to go bad, depending on whether the crisis remains in place or not.
Okay, so a lot of being prudent as well as being cautious. But then how should this interfere with what investors get? Because if I'm an investor today at Equity Bank, I was expecting to be paid my dividend for this year. How do I balance out that management needs to be cautious of the environment that they're operating in, which granted is uncertain, and me as a shareholder? Because I really don't have any other point of benefit from a bank or any other listed company with the exception of the dividend that I actually get. So how do you balance that? They have to they have to enhance the cash position internally, but on the flip side, they've cancelled a 9.4 billion shilling dividend that investors were expecting.
It's a very good question. I'm not sure it's possible to balance it now, especially because the information that has come out is not very clear. Why, for example, cancel the dividend and not give a scrip dividend or not give a bonus. It's not very clear why they took that action, but I think one can look at the impact on the books in terms of impairment in Q1, and one can look at potential projects down the road, like the entry into DRC as sources of cash that the bank sees. Maybe in their projections they didn't expect in place, so they were deploy the 9 to 10 billion in DRC, but now with this crisis in that kind of compounds their problem. Either way, I think it still comes down to them being prudent. And I think what they have to do now is to go out there and communicate to shareholders very strongly and very clearly to make it clear that the long-term prospects of the bank are even better having taken those decisions they have taken. So investors should be happy to, not just hold, but buy more.
Sentiment. But let's talk about DRC. I think about 11 billion, give or take, is what is expected to flow out of the bank in a few weeks as they complete this transaction. Could the fact that they've cancelled out the 9.4 billion, had to incur an expense of 3 billion for their loan loss provisions, could that have any indication, and could that be the deciding factor for them cancelling the dividend that was expected?
Of the calculation for sure, because it's a significant amount of money they expect to deploy, and DRC is actually, I would argue, the best market they're going to be in after Kenya. I think the other small markets they've not been able to do as well. But if you look at the performance from a deposit standpoint, loan standpoint, you can see a significant growth in DRC. And then I guess you can get the economic rationale of moving into a bank that has been there in DRC from beginning, and a bank that's actually doing well. You can get the rationale of DRC being fairly similar to Kenya in terms of Eastern DRC, Swahili speaking, etc., etc. So I think it actually makes a lot of sense from a business standpoint for them to conserve cash as they prepare to make that entry. Yeah,
I think Edwin, I'm still very pessimistic about this decision, because on one end, there's one shareholder or one shareholder's family that's going to receive about 11 billion in a few weeks. But then on the flip side, there's a whole myriad, a whole volume of shareholders who will not be receiving a dividend check for 9.4 billion. But then again, I am not in the management team. It's just trying to understand the numbers. So I think maybe as we come to the tail end of the show, could you walk us through the dynamics of their balance sheet? How did this affect their income statement? And what are the key things that we need to look out for as we progress over the year?
Now, Equity Bank specifically, top line was up double digit, 10%. and that was on the back of a 14.3% growth in interest income, and also on the back of about 15% growth in non-interest income. So it was very, very good performance from a top line standpoint. And I think this was a reflection of the initial transition away from the rate cap regime strategy. They had this strategy of conserving liquidity by investing primarily through government securities. And then when the pill happened, they were in a state of transition. Now they're in limbo, a bit of limbo because of the crisis. But you can see the income lines shooting up the full year and in Q1 because of that transition. So in terms of income, I think the bank was doing extremely well. And in terms of cost, I think the performance was within expectations. So the only thing that throws the whole performance off in the income statement is the bad debt impairment of 3.1 B, which is quite significant compared to the 410 million of a similar period last year. So moving on into the balance sheet, again, they're doing very well, 24% growth in loans, 16% growth in deposits. So that again speaks to the bank's ability to continue to mobilize cheap deposits because the cost of funds remain fairly stable, and also speaks to the strategy of transitioning back to lending, which again now, as I've said, is in a state of limbo because of the crisis. But in terms of, I think the balance sheet, I would argue that they're still very agile, they're still very prepared for whatever happens after. The only thing they're not able to guard against, like any other bank, is what this means in terms of the macros, what this crisis means in terms of the macros, especially for a bank that is mainly an SME bank.
Okay, thank you so much for that overview. We are coming to the tail end of the show. I want you to give us guidance. Okay, all of these things are happening. We're getting a sense of the key risk factors as well as the possible opportunities. What are you telling investors to do in as far as the banking sector is concerned on the NSE?
I think generally this is time to think about a new portfolio from the beginning. Not just banks, but across the board. I think it's time to think about building a new portfolio for the next 4 or 5 years. And I think if you're building a new portfolio for the next 4 or 5 years, Equity Bank has to be on it in the banking sector, because even after this crisis passes, they most likely will be best prepared to deal with the aftermath compared to other mass market banks. And this is preparation in terms of management agility, quickness in decision making, which is important. And then this is also, preparedness in terms of balance sheet liquidity, which is still very good and very well optimized. I think there is a conversation to be had about how they communicate to investors so that investors can manage their expectations appropriately. But I think if you're looking at it from a long-term standpoint, 3 years to go, I think it's a very good place. So yes, I do like Equity Bank from that standpoint. Now, if you're looking in terms of conserving the current portfolio, then you are looking at banks like Absa and Standard Chartered that are not as externalized in terms of foreign exposure, but are also owned by international parent banks that probably, in my view, speak to better corporate governance, speak to better asset quality standards. That's part of the reason why you see those banks performing better in terms of share prices to date compared to local mass market banks. So it really depends. If the strategy is the current portfolio with a very short-term forecast, I am very pro these niche foreign-owned banks. But if you're looking at building a new portfolio 4 years out, 5 years out, I think you have to consider local mass market banks and specifically Equity Bank.
A very good overview. I think allow me to just go into the other sectors, and I will put you on the spot. We have seen the chairman of your investment bank come out in the public realm and say some of the stocks need to be delisted because they are losing companies' money as they report continued losses over losses year in, year out. What's your take of some of the other companies on the NSE in reference to this particular point?
So, it's a fair point. You have about 60 plus listed companies, and only about 6 to 8 that are actually investable by local institutional investors. Foreign aside, local institutional investors. And then you have a problem whereby even out of those 6 to 8 that are investable, the key driver of winners and losers in the last couple of years has been regulation. So you're talking about, changes in tax, you're talking about changes in accounting standards in the banking sector. So yes, you do have a problem with respect to how local institutional investors have fared. They don't have a lot of options. So number one, yes, I do agree that there are some strugglers in the list that have been, struggling for quite a long while now. And you do still have a lot of investors that continue going in, and getting their hearts pumped. I think you've seen some stocks that will shoot up 200% and collapse within 2 days. So I think it would be healthy to minimize speculation in the market by, again, minimizing the number of viable companies that are publicly listed. Yeah.
All right. Thank you so much, Edwin, for your time and your insights. That's all the time we have today. We hope to see you again on our show soon.
Okay. Thank you very much.
Ladies and gentlemen, we have been discussing the Kenya banking results that came out last year. We had discussed I&M Bank, results were down 31%. We've taken a deep dive into Standard Chartered Bank, results were down 16.6%. We've also looked at Equity Bank, results down 14.1%, and Absa, results up 3%. We had two co-analysts sitting with us today. That was Linda and Edwin from Apex and Dyer & Blair, respectively. This is what we've had. There's a lot of things that are happening. Yes, COVID is coming to an end, but then there could be a possibility of a financial crisis. This has meant that the banks have to preserve cash and hold it back in terms of just trying to manage in this world of uncertainty. Cash is king, even from a corporate perspective. If you are looking to invest in the NSE, then you have two options. If you're a current holder, there are some opportunities for you to keep buying additional stocks as they come off on price. We've had Absa and Standard Chartered mentioned, largely because of their dividend payouts that have been consistent and hopefully will continue in the near and the medium term. If you are looking to create a new portfolio, we've had Equity Bank come into that perspective because of its agility and the fact that it's very responsive to adapt its decisions as well as its operations to the market environment. This is what I think. There will be weakness on the NSE, and if you're buying stocks for the future, then it's important for you to avoid the anchoring bias, which is the bias where you say, this is what the banks have done up until now, and that's what I expect them to do in the future. Look at the future as a whole new world. Look at the management decisions that are being made and be conservative in terms of your expectations of dividends. I continue to say, I'm a holder of cash today. After I hold on to cash, I'd possibly put my money with the government of Kenya through infrastructure bonds before I finally come to the riskier asset class, which is the Nairobi Securities Exchange. That said, we continue to look for opportunities on the same exchange, and when we hear about them and when the price is right, this will be the first place that you hear about them. Thank you for your time. See you next time, same day. See you tomorrow, same time, and good evening, or rather good day.